Ladies and gentlemen, good day and welcome to the Max Healthcare's Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suraj Digwalekar from CDR India. Thank you, and over to you.
Thank you. Good morning, everyone, and thank you for joining us on Max Healthcare Q1 FY23 earnings conference call. We have with us today Mr. Abhay Soi, Chairman and Managing Director, and Mr. Yogesh Sareen, Senior Director and Chief Financial Officer of the company. We will begin the call with the opening remarks from the management, following which we will have the forum open for interactive question and answer session. Before we begin, I would like to point out that some statements made in today's discussion may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks. Thank you, and over to you.
Good morning, everyone. It gives me immense pleasure to welcome you to Max Healthcare's earnings call for the first quarter of the ensuing financial year. Let me provide you with the key highlights of the quarter's performance before opening up the forum for question and answers. In continuance of our trend towards the end of the previous quarter, Quarter 1 FY23 was largely a normalized quarter with average occupancies hovering around 74%, while less than 1% of beds were used for COVID patients. It was the highest ever revenue and EBITDA quarter and marks our movement in the direction already articulated earlier. We witnessed consistent performance throughout the quarter, and almost all the operating and financial parameters touched a new high. Consequently, we registered highest revenue, ARPOB, EBITDA per bed, etc. This was driven by improvement in payer mix, surgical medical mix, annual price revision, and normalization of patient footfalls, as we continued to focus on the growth levers set out by us post-Omicron wave. I would like to remind you all, in Quarter 1 last year, we had separately reported a revenue of 136 crores and an EBITDA of 59 crores from COVID-19 vaccination. To that extent, the year-on-year growth numbers are being reported on a like-to-like basis, excluding this non-recurring item. The key highlights for the Quarter 1 performance were the average occupancy for the quarter recovered to 74% from 68% in Quarter 4 FY22, which was largely impacted due to Omicron COVID wave in the first half of Q4 FY22. The bed share of institutional patients, relatively a lower ARPOB channel, has been brought down to 30% from 33% in Q4. This has added to growth in ARPOB as well as EBITDA per bed. This is in line with our guidance and objectives. The ARPOB for this quarter rose to 66,000, implying a growth of 28% year-on-year and 4% quarter-on-quarter. Network gross revenue stood at 1,473 crores, of which rupees 2 crores is contributed by revenue from vaccinations. Gross revenue excluding COVID-19 vaccination grew by 18% year-on-year and 14% quarter-on-quarter. The digital channel's share of revenue was the highest ever at 16% in Quarter 1 FY23 as compared to 13% in Quarter 1 FY22, with website traffic growing by 14% quarter-on-quarter to reach 33 lakh sessions. In absolute terms, the digital revenue stood at 232 crores in Quarter 1 FY23, which is 40% of the digital revenue of rupees 585 crores clocked in the last financial year. That's the whole year. Also, as international medical tourism revenue reached pre-COVID levels in this quarter, despite negligible revenue from Afghanistan, which was one of our key territories till FY20. We continue to expand our geographical presence and expect to have 20+ offices operating from various countries by the end of this financial year. This, coupled with the new Heal in India initiative, should augur well for medical tourism to Max Healthcare as well. We continue to do our bit to provide care to underprivileged. During this quarter, we served 38,500 indigent patients in IPDs and OPDs free of charge. The notional value of this treatment was rupees 49 crores. Network operating EBITDA, excluding COVID-19 vaccination, for Q1 FY23 was rupees 370 crores compared to 301 crores in Q1 FY22 and rupees 304 crores in the fourth quarter of FY22, reflecting a growth of more than 23% year-on-year and more than 22% quarter-on-quarter respectively. EBITDA margin was 26.6% as compared to 24.8% in the fourth quarter FY22, leading to a PAT of rupees 229 crores. EBITDA per bed, most importantly, for the quarter was 62 lakhs, showing an improvement of 10% quarter-on-quarter. Cash generated from operations after interest, tax and replacement capex was rupees 237 crores versus 179 crores in the fourth quarter FY22. Further, net debt reduced to a low of 217 crores at the end of June 22 from rupees 441 crores at the end of the previous quarter. However, the present net debt includes a put option liability of 141 crores. So the actual net debt after that is less than 100. Coming to the strategic business units, Max Lab, which is a non-captive pathology vertical, reported gross revenue of rupees 26 crores. It added 90 channel partners during the first quarter of FY23, taking the overall active clients to 850 plus, spread across 32 cities. On a like-to-like basis, the revenue excluding COVID-19 related tests grew by 50% year-on-year and 24% quarter-on-quarter. We continue to invest in this business and expanded the team to more than 700 people working across functions. Max at Home, our home healthcare vertical, reported gross revenue of 32 crores, a growth of 10% over fourth quarter last year, and representing a growth of 18% year-on-year. The 650 plus strong team at Max at Home also manages a network of 62 medical outposts across corporates, of which 13 medical rooms were added in the first quarter of FY23. Going forward, we continue to employ the following growth levers. 1. International medical tourism growth from both existing and new geographies. 2. Improvement in payer mix. 3. Fast-tracking brownfield expansion. 100 additional beds will be operational in this year at Max Shalimar Bagh, while additional 300 beds in Dwarka would be in early first half FY24. With large capacity addition FY25, we are poised for growth in the foreseeable future. And finally, inorganic expansion in both hospitals and perhaps if we get some good opportunities in the diagnostic space as well. We have also made considerable progress on the digital front and are in the final stage of rolling out our proprietary app, which will not only help us engage with more patients and widen our reach, but also serve our customers better and provide improved experience. On this note, I would like to open up the forum for question and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Damayanti Kerai from HSBC. Please go ahead.
Hi, good morning, Abhay. Abhay, my question is how much price hike you have taken for the hospital services, and also if you can elaborate how price hike flow across different payer groups in terms of change?
So essentially, we have, normally a price impact of about 2 to 2.5% at best year on year at the end of this thing. Okay. What it impacts is essentially the international patients. By that extent, it will impact your cash paying patients. Insurance are typically 2 or 3 year contracts. So, every couple of years it sort of re-triggers. And then you come to the institutional business, which doesn't get impacted by it.
Okay, so this 2 to 2.5 kind of increment which you have taken for the current year, it's already visible for the cash and international patient and insurance, as you said, when contracts are renewed, and the institutional business, it takes longer.
So what we re-triggering right now is that when the new contracts come, will be on the new. So we got plethora of contracts, and all of them don't start at the same time. So if they're 2-year contracts, you can pretty much evenly sort of spread them over 2 years or 3 years. So you'll have some impact of that. Whichever contracts are coming off, are coming on stream or coming up for renewal, they will renew at new prices.
Okay, so does it mean the patient who are paying cash, they have to bear the cost, like higher cost compared to someone who is covered by insurance on an immediate basis?
That's right.
Okay, and in general, like what kind of impact we have seen on healthcare demand due to inflation? So, say like price hikes have gone up. So, any impact on the demand?
I mean, you're seeing the occupancy, right? You're from 68%, you move up to 74% quarter on quarter.
So, we'll say it's immune to price changes because it's essential services. So,
but I think it's a very marginal price change, isn't it? I mean, it's not a very large price change.
No, in general, say like 2 to 2.5 year price hike for this year, but say like inflation goes up meaningfully across the industry, then should we assume any tapering on the demand part?
Look, when inflation comes, one second, okay. And inflation in the industry doesn't impact the consumer, does it? The price hike, as a result of the inflation, impacts the consumer.
Okay.
That's right. Now, if the price hike is 2.5%, that is what is impacting the consumer. Now, if tomorrow inflation is significantly, whatever the inflation has been, you've seen, has gotten absorbed, and you've seen the margin sort of expand in spite of the 2.5% increase in price. So you're better off in terms of margin. That's one. Secondly, and more importantly, if tomorrow there is a further, let's say there is a push of because of inflation and you have to reprice it, then perhaps in October you relook at pricing and say, look, if I have to pass on the inflation, I have to improve the price or increase the price. Your question will become relevant at that stage.
Okay, and this kind of price revision you do once in a year, or it's
once in a year typically, but we always have the option of relooking at it on October 1.
Okay.
I mean, you can even do it every quarter. You can do it mid-year anytime you want. But the fact is, it's disruptive. So I mean, if we have to look at it, we'll look at it at that stage.
Okay.
After 6 months. I mean, every 2 months, 3 months, you can't sort of keep changing your schedule of charges.
Okay, and on the international part, you mentioned it's broadly back to the pre-COVID level, and then you are stepping up your presence in the target market to get more footfalls. So, which key market where you are looking to? Sorry?
That's not what I said. I said we are back to pre-COVID levels, okay, in spite of one of our key markets, which is Afghanistan, okay, giving us negligible business. That was a key market because of travel restrictions from Afghanistan. So when Afghanistan normalizes, that would improve it even further. We're already back to pre-COVID levels because we made efforts in other markets as well, right?
Okay, and finally, like in terms of contribution from international business, how much that can go up in next 2 to 3 years?
And sky's the limit. I think the government is now really focused on this. You'll probably hear on Independence Day, as a part of the Independence Day speech, at least what I'm reading in the press is the Heal in India is going to get a big push, which is India becoming a destination for healthcare tourism, and that is what the government of India and the Prime Minister himself is perhaps going to include in his speech. So that should all augur very well. Sky is the limit. If you're asking me for precise these things, we don't give forward-looking guidances in terms of specific numbers like that. But look, I think you have a huge comparative advantage in India with the right push and the right encouragement from the government. Literally, sky is the limit as far as I'm concerned.
Okay, thank you. I'll get back in the queue.
Thank you.
Thank you. The next question is from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Yeah, hi, good morning. Thanks a lot. My question is on the new beds and the associated costs that will have to be incurred for the new bed expansion that the company is undertaking. In FY22, the company had indirect overheads of 1,700 odd crores, which was associated to 3,200 capacity beds. Roughly 54 lakhs or 53 lakhs cost per bed is the indirect overhead that I am able to calculate on a ballpark basis in FY22. With 100, 300 and 1,200 beds likely to be added next 3 years, we are looking at a bed build-up of 1,570. So when I look at the cost build-up for the new beds, should I multiply this 1,570 beds with the indirect overhead you have on the existing capacity beds, or it would be lower? If you can give some sense, what kind of cost build-up should be associated with the new beds that are coming on stream?
Largely they're brownfield. If you see out of the 3,000 beds, 80% of the new capacity is brownfield, right? In a brownfield, you already have your management cost as well as your senior clinician cost being incurred by the subsisting hospitals. So, I would look at it a little differently. Rather than looking at the cost and start dividing it, I'll say, okay, look, my EBITDA per bed is 62 lakhs today. Right now, this 62 lakhs, what is it going to be 3 years down the line? And more, with the payer mix distillation, any inflation and increase in price and so on and so forth. But that is what is going to be attributable to the old capacity. The new capacity which comes up, okay, will have some operating leverage in it simply because, like I said, you're not going to have a lot of the costs are already being incurred within the 62 lakhs per bed. So that number for the additional beds should be higher, theoretically. So you would take the EBITDA per bed and multiply it by the occupancy in those installed beds. That's how you would look at it. I don't see any major fixed costs coming on brownfield.
Okay. So before these beds come on stream, whatever EBITDA per bed the company kind of stabilizes at, let's say next 2 or 3 quarters, while the new beds will come on stream, there should not be any major dilution on EBITDA per bed. Would that be a fair assessment? Or
That's correct. Which we've guided to also in brownfields. Typically, your break-even is the first quarter or whatever. And we've seen that in Vaishali Hospital, we came up with 100 odd beds. There was no and these are required. These hospitals are operating at 80% occupancy. You put another 100 beds, that gets taken up pretty quickly. So we don't see any abatement in EBITDA in absolute terms.
Got it. And 2 near-term bed additions in Shalimar Bagh and Dwarka. In the last 2 investor presentations, the timeline has remained same. So can you highlight some milestones which would have been achieved in both these facilities, just to give some comfort that these bed additions are on track?
Dwarka is at finishing stage, and as far as Shalimar Bagh is concerned, is late in finishing stage. If you're going to open up one capacity in the current year, you've already got, and the current year means that obviously, you're looking at the next 6 to 9 months, okay, and then the new capacity in perhaps 3 to 4 months after that, you have to be pretty close to finishing, and that's what on the ground reality is.
Got it.
So I'm not giving you visibility on something 3 years later. If you're saying something is coming up in 6 months or 9 months, right? Then obviously the structure, everything is ready. You're doing fit outs and stuff like that.
Sure. And third question is on the international patients. Can you give me the number of beds which are occupied by international patients in this particular quarter, and what this number of beds can look like, let's say, in 12 months?
First question, answer the first question, I think about 6%, but you guys just sort of lean in on this. But secondly, like I said, I'm not giving any guidance on where it can be. Sky's the limit, like I said. So that number can keep moving up. I mean,
it's 4.5 to 5% of the beds were occupied by the international patients this quarter.
4.5 to 5%.
Okay, so the revenue mix and the bed count mix is the same. So I mean, my understanding might be wrong, but I thought that international patients come in at a much higher ARPOB, right?
That's right. So therefore,
you see that the overall revenue share is 8% and the bed share is 4.5-5%, right? That signifies that.
Oh, I'm looking at the wrong number. Sorry. Yeah, my bad. Yeah, sure. Okay, sure. This helps. Thanks a lot.
Thank you. The next question is from the line of Praveen Sahai from Edelweiss Wealth Management. Please go ahead.
Yeah, thank you for the question and many congratulations on a very good set of numbers. The first question is just I'm repeating, the earlier question that's related to the EBITDA per bed. As you said, that's down the line 3 years with the new capacity coming in place. We will manage this EBITDA per bed from there, or is there some deterioration we can see?
Like I said, look, 80% of the capacity is coming in the form of brownfields, right?
Mm-hmm.
What is the brownfield? You have an existing hospital which is operating, let's say, at 80-85% occupancy. You are waiting in your ER for a couple of days for beds. Okay, the hospital's run out of space. Okay, where do you go from there? You put up another building adjacent or right next to it. Now, okay, so you incur the capex of the building. Okay, now your CEO, your management, your clinicians, etc. Already, all your sort of fixed indirect cost is already being incurred by the existing hospital. So let's say in the new building I want to open, which is 100 beds, but I only have demand for 20 beds. I'll only open 20 beds over there. I'll put nurses, etc. of 20 beds.
Mm-hmm. So
my building is ready. Okay, my fixed cost, this thing is already there. So also the higher operating leverage. So I don't see your EBITDA margins or your EBITDA per bed going down because of it. It should be accretive theoretically.
And as you are in the this year and the coming year coming capacity in the Shalimar Bagh and the Dwarika, so with this any change in the clinical mix also we can say because
no, this has got nothing to do with the clinical mix.
Okay, because they have a certain different clinical mix and they are on the lower side of a bed, so that's why I'm asking this question whether this pure over. So like Shalimar Bagh and Dwarika has some different, on the company level, it's a different clinical mix. So is there any impact you are expected to see in the next 2 years in your clinical mix on the overall company level?
Where do you see from a company level it's a different clinical mix, Dwarka and Shalimar Bagh?
Oh, it's a similar, you are saying?
No, I'm asking you, is there, I don't think the specific hospital clinical mix is something that we have guided to.
Okay. So now the next question is related to the payer mix, and which you had guided earlier for a institution business to go down to a 15%. So what's the timeline for that? When you want it?
Over the next year and a half. I mean, do keep in mind this was 37%. Previous quarter it was brought down to 34%, 33. Now it's down to sub 30, and hopefully. Yeah, I mean, that's been the trajectory, right? So next year and a half, it should be down to 15 or below.
Okay. And last question on the occupancy side. The current occupancy level, you are seeing this as a normal 75-76% is a normal rate which you will run on?
I mean, pre-COVID levels, we used to be 71-72%. Okay. I mean, obviously, disease burden goes up. We've also operated, as you've seen, at 81, 82%. On a sustainable basis, I've said in the past, we can go up to 77, 76, 77%, okay, across the network, at the network level. And these are midnight occupancies. So, I mean, there could be a couple of percentage points sort of over a period of time, but that's about it. It's marginal. So the real value will come from the distilling the payer mix.
Okay. Thank you for that. And in the inorganic, are you also looking in the hospital business? Any opportunity?
Well, we are mostly looking only in the hospital business opportunities, to be honest.
Not in diagnostic?
Well, not actively at present.
Okay. Thank you, sir. All the best.
Thank you.
Thank you. The next question is from the line of Sangeeta Purushottam from Cogito. Please go ahead.
Hi, this is Andre Purushottam, Sangeeta's partner. Abhay, just a little bit more light on your margin drivers. Specifically, if you were to, look at a 2 or 3 year term horizon, how do you see your international tourism shaping up in terms of percentage of revenue from 7.3% or so? And also in terms of, I believe your CGHS proportion to revenue is already low as compared to other hospitals. Would you be seeing this coming down to zero in the near future and seeing it substituted by higher margin payers? And what other elements of the mix can you, add further color to, which would give us an idea as to how your margin would expand in a 2 or 3 year horizon?
So first, I think your presumption is incorrect.
Okay.
Compared to our peer group, our institutional business, CGHS business, etc., is the highest.
Okay.
It's more than twice of Apollo and maybe more than 50-70% of Fortis.
Right.
Secondly, we are not giving any guidance on margins like we've desisted from doing that in the past. Okay, and like in this call also said, international business, I'm not going to give you. I can tell you what the opportunity set is, which is a great listing. I've been a big proponent of international medical tourism, and really, I think the big fillip we are going to get now is because the government of India, okay, is putting its weight behind it. Okay, and we are reading about Heal in India initiative, okay, again, which the Prime Minister may take up on his Independence Day speech, which is a big thing. When the Prime Minister takes it up, the rest of the ministries and organizations will follow. So I see a huge opportunity emanating from that. I've always been a proponent that we have a big comparative advantage. I think it's being recognized at present. A little difficult for me to answer what percentage of that business is because, like I said, even if I have an internal assessment, it's something that we've desisted from giving forward-looking guidances on margins as well as this. What we have said is that the levers, and you can perhaps make that out, okay, for our margin improvements going forward, besides medical tourism, is going to be a key, is distilling the payer mix, that means reducing the institutional business, which we are from 30-odd% looking to bring down below 15% over the next year and a half. Right. This business, okay, yields us 45 to 50% lower revenues, okay, and once this business is replaced by, as we are seeing is trending also, okay, by our non-institutional business, it will generate 45 to 50% more revenues, and 85% of that comes straight to our EBITDA. So that can has a major impact on both our ARPOBs as well as EBITDA per bed.
So this reduction in the share of the institutional business, what impact would it have on occupancy rates, and would you be able to keep the same occupancy rates that you have right now? From what you said earlier in the call, you operate, let's say, on an average of maybe 77, 78% as kind of sustainable occupancy rates, right? So how do you see the trade-off between that and...
There is no trade-off. I think you're looking at the wrong equation. Okay. See, today we do this business not because we want to, not because we have to, because we want to. Rather than keeping a bed idle, we'd rather do institutional business, right?
Right.
It's not as if you stop the institutional business, make the bed idle, okay, and then hope you're going to get business.
Right.
Okay, because if that was the case, then we would never start doing this business. The way to do it is, okay, that today we have non-institutional business which are preferred channel, right? Which has a certain rate of growth. Now I won't even go down to all the aspirational things on international business, etc., that we're doing. Forget all of that. I think that business has been growing at a particular rate. Now we've already hit an overall ceiling almost as far as the occupancy is concerned. Like you rightly alluded, that you're already at 74-75%.
Right.
So I mean, where do you go from here? Maybe a couple of percentage points.
Right.
The preferred channel is growing. Okay, requires more beds, 200 odd more beds per year. Where do you get them from? I have to displace my institutional business.
Right.
So, each hospital of ours has about 200 contracts with various public sector undertakings, so on and so forth. And these are hospital level contracts, which are for a period of 6 to 9 months, and then you have a notice period of 1 month, both sides, if you want to discontinue. So you keep switching off one after the other on a particular hospital wherever you have no beds for your preferred channel, effectively.
Right.
Case in point was our Gurgaon facility. We used to do 20% business from the institutions. Okay, now it's down to 0. But our EBITDA per bed over there is 90 lakh plus.
Right.
Compared to 60 lakhs for the rest of the thing, because of that.
Right.
So I hope I've been able to sort of answer your question in some manner. So it's not either or. I mean, once we have the demand, we move away. So you don't ever see a reduction in occupancy because we're moving from institutional.
Okay. And one last clarification. A lower ALS is good for you commercially?
Sorry?
Lower the average length of stay, the better it is commercially for you?
That's right. That's a key indicator of all hospitals. For any hospital, okay, you make money in the surgeries of the procedure. Most profitable thing are day care.
Right.
Okay, the longer a patient stays in a hospital, it's loss-making. So every day a patient stays in a hospital is actually loss-making.
Right.
Most people believe that hospitals are holding them back and making money, etc. It's the other way around. The hospitals want you out.
Yeah. Because all the expenditure really becomes upfronted, right, on the first day itself.
That's right. So your returns on daycare, etc. The rooms, etc. is 4,000 rupees, 5,000 rupees a room with the nurses, with this, with that, etc. You can imagine.
Right. Thank you. Thanks very much, Abhay.
Thank you.
Thank you. The next question is from the line of Dhiresh Pathak from White Oak. Please go ahead.
Yeah, thanks for taking the question. This slide which says that capex for the quarter was 13 crores only, and there's another slide which says that total capex for the year is supposed to be some 600 plus. So why was this quarter low?
Yeah, I think we haven't really made the payment to the contractors. So there was already advances issued in last quarter. So I think we'll be making some payments in this quarter now. It's only cash outflow stuff, right? It doesn't have any to do with the work which is happening at the site, right?
Okay, so work at the Saket site and the Nanavati site, how are they progressing?
So Nanavati side, the piling work is on, more or less, more than 70% of the piling has been done, the D-wall has been done. We will start, demolition has been done, construction is going to start the digging is going to start now. Almost all the approvals are in place. As far as Saket is concerned, I think retaining wall has been done. Recently, we have to transplant trees. There was a order that you can't transplant trees in Delhi. Now the order has come that you can transplant trees. We transplant those trees. So we are doing that, and I think work should start. I think work has already started. I think construction should start.
Okay.
The next, you have to make a retaining wall, you have to make a D wall, you have to do piling, you have to do foundations, etc.
Yeah, more than that, I wanted that all the approvals that were like the tree issue and all those government approvals are in place, right? So it's in our control. Okay. The second question was on the Max Labs. So I'm just trying to understand that there's a gross revenue of 40 and then there is a net of 25. So the balance is payment to the collection center as well as to the Max Hospital Lab. That only represents payment to the collection center and payment to the lab gets charged later in the cost line item.
No, so we recognize the revenue on a net basis in our financial. This is GMV, right? So don't compare the GMV. GMV is basically, for example, what is the franchisee charging or the center charging to the patient, and also we have some HLMs, right, where they charge it to the managed third-party hospital labs also. So obviously, we get, for example, 60% of the revenue and 40% that is a markup when the hospital is charging the patients. So the 40 is not coming in the revenue line. We consider only for 25 in the revenue line.
Yeah, that I understood. So my question was that of the 40 and the 25, the difference is 15. This 15 includes both, right? The payment to the collection center, which is third party, and payment to our hospital labs.
No.
15 is only payment to collection center. Payment 40% of the net revenue, which is payment to the lab, that will be as an expense line item later.
So when you send the sample to the hospital lab will charge you a cost, right? That's coming your cost line. It doesn't come to the revenue line, right?
So if the patient is paying,
if you pick up 100 rupees worth of sample, from the March date, which is certification, you probably give a 25% discount to the franchisee. 75% got the certification, so that's your revenue line. 100 is GMV, and then you send the sample to the hospital. The hospital charge you for testing the sample. That comes your cost line. Is that clear?
Right. So based on what we are showing, it seems if the customer is paying 100, we are getting only 1/3, right? 40% is going to the collection center, and 25% or so is going to the lab.
No, I think you're confused. So what I'm saying is 40 is getting charged to the patient, 25 is coming revenue in our books, right? We are collecting 25. And of that collection, then we are getting the sample tested in the hospital lab. There's a transfer pricing mechanism there. So then they pay part of that money to hospital for testing the lab, right? For testing the samples. So 25 is what we get collected. So 40 to 25 is what the money which is paid to the third-party hospital as well as third-party, franchise.
Understood. Okay. Thank you.
Thank you. The next question is from the line of Harith Ahmed from Spark Capital. Please go ahead.
Good morning. Thanks for the opportunity. My first question is on one of your closest peers who announced a foray into Gurgaon, which is Apollo Hospitals, and they've acquired a 650-bed hospital there. And we also have a significant presence in the region, and then we've announced a 1,000-bed expansion as well. So, firstly, any thoughts on the incremental competitive intensity in this important micro market? And secondly, if you could give an update on the status of the two projects that we have announced.
So I think first and foremost, this particular target or what they acquired has been available in the market for 6 years. Okay, and it's been available, and there's a reason that they were the only bidders right now, or the only people through a bilateral listing. We have passed it on numerous times in the past, and we've passed it on off again. So I mean, that's the extent I'd like to sort of go through for not doing that. And so I mean, I don't see any threat or real challenge coming from that.
Okay, and my second one is on Max Labs. Currently, we're tracking a
significant thing in Delhi. I mean, you have to keep in mind today, Max Hospital is equal to the size of perhaps Apollo, Medanta, Fortis, and maybe somebody else put together.
Understood. On Max Labs, currently the net revenues are tracking at a quarterly run rate of around 25 crores. And is there an aspirational revenue target that we've set for this business, let's say over the next 3 years from the current 100 crore annualized level? And do we plan to explore any other adjacencies such as pharmacy, retail, or primary care clinics to further leverage the brand?
No, we're not looking at doing anything to leverage the brand, which is unviable. Primary clinics, etc., are not the most viable thing. We've been in that and we rolled it back. I think we've seen it with some of the other competitors also. They've done that, either paused on it or whatever else it is. As far as Max Lab is concerned, it's a business. We have aspirations. We've had a 3-year, 5-year plan and so on. Of course, tactically, you have to keep changing, and the outlook will keep changing depending on what others are doing and what market is. Right now, market is disruptive in terms of discounts, etc. We don't participate in that because our sort of client base is very different. So yes, we continue to build this business out, and we've seen, although on a small base, good growth both quarter on quarter, year on year. So 50% year-on-year growth and a 24% quarter-on-quarter growth in a non-COVID business in Max Lab is very, very healthy. So we will continue to invest and grow this business. It has multiple benefits for us. A, brand reach. B, it's an important part of our offering to be able to do home pickups for our patients, etc., and to reach out to more and more people. So yes, I think we will continue to build this business in Slightly challenging times right now because of more of what is happening in the marketplace. But these things are known to settle. At some point in time, the discounting and there will be some shakedown in the industry, and hopefully we will get back to building this business to what our previous aspirations were. As in before, we avoid or desist from giving any forward-looking statements, so I don't want to make a statement, this is what I wish to be in 3 years.
Okay, got it. Last one, if I may.
Coming to Max at Home, I think that's a very, very interesting business. Okay, it's again something which is about 30 odd crores in this quarter, but it's been a healthy 10% growth over last quarter and 18% growth year on year. It's a business of the future, in my belief. We've been doing it for many years. We've got more than it's a profitable business. Most importantly, it's perhaps the only profitable home care business in the country. We've got more than 650 people doing this business, so we are, foreseeing great opportunities here as well. But again, I want to desist from giving you 2 year or 3 year,
Yeah. So, is there a standalone profitability for this business that you can share, like you shared for Max Labs?
I think mid-teens sort of EBITDA margin.
Okay, understood. Thanks for taking my questions.
Thank you. The next question is from the line of Ashwin Agarwal from Akash Ganga Investments Private Limited. Please go ahead.
Congratulations to the Max team. And Abhay, in last 3 years, you have built a fantastic franchise. I think Max stacks well in all the operational parameters compared to the peer group. I had one question for you. One of the co-promoters, KKR, as we know, for their own internal reasons, is selling their stake. If there is a potential stake sale of the entire, would you be looking out for financial investors, or what is the strategy on that front?
I think, it's a private equity fund. Private equity funds are known to churn their portfolios and sell because they have a particular holding period in mind. Their holding period for this investment was 7 years. They've only done 3 years, but yes, they've seen great returns, because of the performance of the company. So, they have sold down about 20 odd percent in the last 6-8 months. The flip side, it's a large amount of stock which is coming to the market, yet you do have to keep in mind that the trading in our stock is not very large. It's basically because whatever has been sold also has gone into a lot of the long hands. And these long hands don't, sort of trade in the stock. So your trading volumes are 2-3 lakh shares, 2-3 lakh shares or whatever. So I'm not that sort of worried about, further stock coming into the market in the future. As a private equity fund, it's a matter of time rather than, it's not a question of if, it's a question of when. But yet, they've been very clear in stating, and we put it out, in the news item as well as a part of a release to the stock exchanges, that they are not in any conversations with any strategic buyers or conglomerates, etc. So what that basically leaves it is sale in the marketplace only.
Okay, but in future, whenever that term or their holding period, maybe next 1, 2, 3 years, would you, in consultation with them, look at placing this large stock among 2-3 long-term investors rather than it coming to the market?
I mean, even right now, the 20% which is sold has been gone to long-term investors only, no?
Okay.
I mean, if you actually see, right now, if you look at the stock, between KKR and we have 50% of the company.
Correct.
But the balance 50%, which is about 18,000 crores of stock is out there in the market.
Okay.
Which is about 48 crore shares. Yet the trading in shares is about 2 lakh or 3 lakh a day.
Okay. So you're not disturbed with having 23% stake and the other co-promoter selling off whenever they need to?
No, I don't have any concerns on that. I think there are immense examples of companies where the promoters have shareholding in this range. I mean, be it players like Cipla, be it players like UPL, be it players like, a lot of the Tata Group companies and other companies as well. So I think, I'm not concerned about shareholding and, a balanced shareholding going out in the marketplace.
Thank you and wish you all the best.
Thank you.
Thank you. The next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, hi, good morning. Just one question on, the growth. So we had a fantastic, ARPOB growth, occupancy itself has increased substantially, and business seems to be normalizing now. Now the question is, the growth and the margin, EBITDA growth, both are mid-single digit. So you mentioned in your opening remarks what are the levers, but when do we see these levers playing out? Is it from next year onwards, and this year would be still this mid-single digit, or how do we see the business shaping out over the 9 months period, given that, there are a lot of initiatives which are at play?
I think, where it's going to shape out and what the margin is going to be is something for you to work out. I can essentially tell you what the levers are. And you can see what the main levers will be international, will be the payer mix, there'll be other smaller sort of this thing. Do keep in mind 2 things. Quarter 1 typically is not the strongest quarter because you have price increases, etc. in the first quarter. Okay, yet we don't have a bad quarter in the first quarter this year. That's 1. Second is the payer mix, like I said, from 33%, in 1 quarter it came down to 30. Over the next 6 quarters, you're expecting it to below 15%. That means 15% of your beds will be able to generate about 45 or 50% more revenue. Then 85% of that will go down to your EBITDA. This is on top of what your regular growth should be. So if you do the math, you'll come to some sort of a, but that's for you to analyze. I'm going to desist from giving any forward-looking, and we haven't given in the past also guidance as far as the numbers.
I understand. I'm not asking for, the percentage, or I'm saying when do you see this happening? I mean, this, because we are sitting on a decent base given the strong execution we have done over the last 2 years. Just trying to understand when does it start playing out double-digit growth, or with the addition of new beds, then only we start seeing that, or it can happen.
Aren't you already seeing? Sorry, you're talking about double-digit growth?
That's right. Yes.
So double-digit growth as far as
top line and EBITDA is concerned?
I have not guided you double-digit growth at top line or this thing. It's something that you're working out. That's 1. Okay, you're already seeing some sort of growth, which is, I think, quarter on quarter at least has been double digits. You're already seeing the 33% come down to 30. So your growth right now is embedded with some payer mix churn as well. Okay, and when we are guiding it down to 15%, then your only question can be: is it going to get bunched up in the last quarter of on the 6th quarter, or is it going to happen sequentially, or how is it going to sort of play out? That's why we can't do it on a quarter-on-quarter, month-on-month basis, and I refuse to give that sort of guidance. Now, if you want to draw a linear line, you're welcome to between where we are today from 30% beds going towards institutional payer mix to 15% in the 6th quarter.
Okay. Fair enough. And
15% on a like-to-like basis, and the EBITDA growth is 23% on like-to-like basis, right? So if we take the vaccination out from the quarter 1, which we knew is non-recurring, and we reported that number separately also in quarter 1 last year. If you take that out, I'm saying if you compare the numbers, it's a 17% plus growth, right? And the EBITDA is also growing by 23% plus. So I don't know when you say that double-digit growth. So I don't know what do you mean by that.
No, I'm talking about reported basis. So there was COVID, and then non-COVID was down. Now non-COVID is fully up, whereas COVID is down. So I'm just saying on a Concall and
we haven't taken the COVID out. What we've taken out is only the vaccination. We know that vaccination was not non-vaccine thing, and I believe that's the reason why you reported numbers separately for the vaccination. So I'm not taking the COVID out. I'm taking only the vaccination out, right? Which is actually a OPD business. And it was, not inside the hospital, right?
Oh, I understand that. Thank you. And secondly, I just wanted to understand the Shalimar, which is getting added by end of, this calendar or by fiscal end. How do you see the ramp up? I mean, given that, your turnarounds are pretty fast. So what is the plan here? And similarly, if you can guide for Dwarka also.
Like I mentioned, your ramp up should be very quick, right? I mean, and it will not have any, at least by Shalimar Bagh is brownfield, it should be very quickly. As far as Dwarka is concerned, it's not brownfield, it will be a little longer. We expect break even within the year. It's on a large base of 3,500 beds that you're looking at another 300 beds coming up. So it should not disturb your numbers too much.
Okay. And lastly, if I look at Devki Devi particularly, sales have been soft, but margin has improved significantly. Anything happening there you want to call out?
Not particularly. Yogesh?
No, but I don't understand what you're saying. What's the question?
You're seeing margin improve in Devki Devi. I didn't quite get that.
Yeah, Prakash, don't read too much into it. There will be some payments which these people made, which is on a, Devki Devi has to donate some money, etc., to one of the trusts. That payment comes when they come.
I think he's talking about the margin improving. Can you repeat your question, Prakash?
Yeah. So if I see the slide that you have provided, where the sales is
slide. Recall slide is saying.
Hello.
The recall slide you're talking about, right?
Yeah, the slide where you have that revenue and EBITDA breakup.
Yeah.
So the statement is, whereas there is a strong growth in
the individual hospital slide. I'm saying those movements happen from quarter on quarter, because sometimes they have to make some donations, etc., which they made when they made. I would say, yes, there is improvement overall in all the hospitals if you compare with quarter 4. That the EBITDA has gone from 304 to 370. So obviously you will see that in the underlying hospital also. So that's a welcome step. The point I'm making is that don't read too much into it. I think the gross number is what is more important than the individual, especially at a PHF level, right? Because here the agreements get revised, and when the agreement get revised, then maybe they'll have more charge into the P&L, and then that will come to the MHL side, right? So that the reasons will happen in the course of this year. So I think this may be a temporary phenomenon before the agreement revision takes place.
Okay, perfect. And lastly, on the further growth initiatives, so next 5-6 years we all set with a stated plan of bed additions. But we've also talked about REIT kind of structure, asset light, development, tie-up with developers, or ready to move in hospital kind of setups. Is there anything on, we're still looking at it, or our hands are pretty tied up with the existing expansion plan?
Dwarka is just that, isn't it? Dwarka is tied with the development.
And that is known. That is known. I was asking, is there anything else that is in the drawing board?
Yeah. So there's plenty on this thing. I think, there are quite a few conversations out around that.
Okay, lovely.
It is a big focus area for us.
Yeah. Perfect. Great. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Yash Shah from Investec. Go ahead.
Hi sir, I just got one question. Given that our international patients footfall is back to pre-COVID levels and Afghanistan is not completely back, which country have we exactly seen sudden inflow? And what I wanted to understand is it sustainable in your opinion?
Sorry, I can't.
Sorry to interrupt, Mr. Shah, but your voice is not clear, sir. There is a lot of...
Okay. Is this audible? Like, is this fine?
Better.
Is it better?
Yes.
Okay. Sir, what my question was is, given that our revenue or our footfalls from international patients, it is back to pre-COVID levels, right? And Afghanistan is not completely back as compared to FY20, right? So I just wanted to understand which country have you seen sudden inflow, like in footfalls? And do you think it is sustainable? Will we be able to sustain from the footfalls from the same country?
Yes. So it is sustainable. It is. We've been making efforts of entry into new markets and increasing also our patient flow from our existing markets, which is sort of got augmented and absorbed the Afghanistan lack of business from Afghanistan. I am going to again desist from giving you specific names of new markets because I don't want to do it in a public forum. Yes, so but we do see stickiness about this business. In fact, more stickiness with this business because this is a result of a lot of direct-to-fly offices that we are setting up overseas.
Got it, sir. And just one small clarification. When we say our international footfalls is back to pre-COVID levels, we mean the revenue, right? 11% which was there in FY20.
That is what in absolute terms, yes. Absolute terms, that's right.
Okay. Got it. Thank you so much, sir. Thank you.
Thank you. The next question is from the line of Amit Thawani, an individual investor. Please go ahead.
Hi. Thank you for taking my call. It's always a pleasure hearing you, Abhay. Can you discuss what levers, are there any low-hanging fruits still there in RBOC? And I mean, when you look at RBOC as something where we can guide for certain QOQ growth, or we think we're going to see seasonality in the RBOC, or are there any low-hanging fruits to take this higher? I wanted to just know your thoughts there, or
First and the most primarily the low-hanging fruit, the payer mix, non-institutional, which we've been speaking about on this call, and second is international business. As far as seasonality is concerned, there is a slight seasonality. Typically the fourth quarter is the best. Your first quarter and your third quarter are typically not the strongest quarters, etc. But so that's where we are.
Thank you so much.
Thank you. Participants who wishes to ask question may press star and 1. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
So thank you so much for being on the call. The results are robust, as you can see, but don't come as a surprise for us in some manner. And you've been a part of the calls in the past. You've seen us guide towards normalization and these sort of results. And we are quite certain that this path should continue going forward as well. Thank you.
Thank you
very much. Yeah.
On behalf of Max Healthcare, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.